Hey everyone, welcome back to Corporate Decoder, and today we are diving deep into ZoomInfo Technologies Incorporated's financial report. It looks like this company that helps businesses find and connect with their customers had a mixed year with one eye on growth and the other on restructuring. Let's see what the numbers really say. And hey, if you love cutting through the corporate jargon to get to the real story, make sure you hit that subscribe button and join our Discord community linked in the description below. ZoomInfo Incorporated is a major player in the go-to market software scene. They provide data and intelligence for sales, marketing, and recruiting teams. Think of them as the intelligence agency for business development, helping companies find the right leads and understand them better. They break their platform into three parts. The intelligence layer, which is the data itself, the orchestration layer, which brings that data into customer systems, and the engagement layer, which helps teams act on those insights. Their customer base is massive, spanning almost every industry from software giants to small businesses. They offer subscriptions based on features, users, and data access. Their bread and butter products are things like ZoomInfo Copilot, sales, marketing, operations, and talent. For the year ending the 31st of December 2025, ZoomInfo pulled in $1.2495 billion in revenue. This is an increase of about 3% from the previous year, which was $1.2143 billion. This growth seems to be linked to some operational changes they made in the second quarter of 2024. Now let's look at their profitability. They had an income from operations of $225.7 million in 2025. That is a huge jump of 132% from just $97.4 million in 2024. This means their core business operations are much healthier this year. Their operating income margin also improved significantly from 8% in 2024 to 18% in 25. And at the bottom line, their net income was $124.2 million in 2025, a massive leap from $29.1 million in 2024, an increase of over 300%. They also report non-GAAP financials, which are pretty important for understanding their underlying performance. Their adjusted operating income was $445.9 million for 2025, up from $428.5 million in 2024. The adjusted operating income margin was 36%, which is slightly up from 35% last year. This suggests that even after adjusting for certain costs, the company's operating performance is strong and improving. What is interesting is how much they've managed to reduce their expenses, especially those related to restructuring. In 2024, they had $101.6 million in restructuring costs, but in 2025, that dropped dramatically to $40.3 million. This significant drop mainly came from lower lease impairment and abandonment charges in 2024 compared to 2025, which is a good sign that some of their past burdens are easing. Looking at customer retention, their net revenue retention rate was 90% as of the 31st of December 2025, which is up from 87% the previous year. This is a positive indicator suggesting that their existing customers are spending more with them over time. They also noted a particular focus on larger customers, those with over $100,000 in annual contract value, increasing from 1867 in 2024 to 1921 in 2025. These larger clients now account for over half of their total annual contract value. Financially, the company seems to be in a solid spot for liquidity. As of the 31st of December 2025, they had cash and cash equivalents of $175.9 million plus $4 million in short-term investments. They also have $150 million available under their revolving credit facility. Their total cash position was $185.7 million, up from $149 million the previous year. Operationally, they brought in $465.4 million in cash from operations in 2025, a nice increase from $369.4 million in 2024. This shows strong cash generation from their core business. However, they did spend quite a bit on repurchasing their own stock. In 2025, they spent $411.1 million on share buybacks, which reduced their overall cash position. This action, along with tax receivable agreement payments and other financing activities, meant their net cash used in financing was $347.9 million. Now, on to risks. Like many tech companies, customer spending can be impacted by economic slowdowns, which they highlighted as a major concern. Data privacy laws are also a significant risk with ongoing changes in regulations globally. They also mentioned potential competition from large language model providers and generative AI companies, which could disrupt their market. On the internal controls front, the auditors KPMG confirmed that ZoomInfo maintained effective internal controls over financial reporting. This is crucial for investor confidence and the integrity of their financial reporting. They did identify a critical audit matter related to the valuation of deferred tax assets, which is pretty common for companies with significant intangible assets and goodwill. The auditors had to do some extra work there to be sure the numbers made sense. Legally, they are facing several lawsuits. These include claims related to privacy laws in Washington and Quebec, allegations of violating Colorado's telemarketing laws, and shareholder lawsuits alleging misleading public statements. They state they intend to vigorously defend against all of these, which is standard language, but shows the legal landscape they navigate. The company's stock trades on the Nasdaq under the symbol GTM. They have no current plans to pay dividends, which is typical for growth-oriented tech companies reinvesting profits back into the business. One interesting detail is the CEO's compensation. They were granted a significant number of performance-based stock options with very ambitious targets tied to stock price and free cash flow growth. If achieved, this aligns the CEO's interest strongly with shareholder value, but it's a high bar to clear. So what is my take on ZoomInfo Incorporated? Their core business seems to be really performing well, demonstrated by the strong growth in operating income and net income. They are growing revenue and, more importantly, retaining and expanding their customer base, especially with those higher value enterprise clients. The reduction in restructuring expenses is also a positive signal that they are moving past some of the costs associated with past growth strategies or facility adjustments. However, the risks are real. Economic headwinds, changing data privacy regulations, and the ever-evolving AI landscape are significant challenges. They are also facing substantial legal battles which could have unpredictable outcomes and costs. Their debt levels are also something to watch, although their leverage ratios seem manageable for now. In conclusion, ZoomInfo seems to be on a good trajectory operationally with strong underlying business performance. The market data and expense management improvements are positive signs. The key for them moving forward will be navigating those external risks, especially regulatory changes and potential competitive shifts in the AI space, while maintaining this operational momentum. Alright, that is our deep dive into ZoomInfo's latest financial report. What do you think about their performance and their strategy for the future? Let us know in the comments below. If you found this breakdown useful, please smash that like button and subscribe for more unfiltered corporate analysis. And don't forget to join our Discord community for even more discussions and insights straight from the filings. Thanks for watching, and we will see you next time on Corporate Decoder.